Today, we're doing a full corporate health checkup on a name you almost certainly have in your kitchen, General Mills. We're going to dive deep into their business, using their latest annual report as our guide to see how they are really doing.
I mean, you see Cheerios, Pillsbury, Old El Paso on the shelves every single time you go to the store. But behind those familiar logos is a massive global business, and right now it's facing some pretty serious challenges. So, what's really happening behind the curtain? Well, that's exactly the question we're here to answer.
All right, first up, the Giants annual checkup. To really understand the health of a company that makes everything from your breakfast cereal to your dog's favorite food, you have to look at the whole picture.
So let's get right to the diagnosis for fiscal 2025. We're going to start with the top line financials. Think of these as the vital signs that tell the main story of the past year.
Okay, let's start with net sales. They came in at a massive $19.5 billion. But, a number that big can be a little misleading. The real story here is that sales are actually down 2% from last year. And that's our first clear sign that it wasn't exactly a blockbuster year.
And that downward trend, it continues with operating profit, which landed at $3.3 billion. That's a 4% drop. So this means not only did General Mills sell less stuff, but they also made less profit on each thing they sold. The pressure was definitely on. And you can see how that pressure flows right down to the investors. Diluted earnings per share, a really key metric for the stock market, fell 5% to $4.10. So if you take these three numbers together, they paint a very clear picture, a consistent downward trend for the year.
So what's the story behind these numbers? Why the dip? This quote from the company's own management really says it all. They point directly to value-seeking behaviors by consumers that were deeper and more prolonged than we expected. In other words, shoppers were hunting for deals, being a lot more careful with their money than the company thought they'd be, and that really squeezed their bottom line.
All right, so we've seen the overall picture. Now, let's go a level deeper and look inside the company's different business engines. Because General Mills isn't just one single thing. It's really made up of four distinct parts, and trust me, they each tell a very different story. And this table here lays out that story perfectly. It is a real mixed bag. Just look at North America retail. That's their biggest piece of the pie, by far. Net sales down 5% and operating profit down a pretty sharp 11%. This is where that consumer value seeking hit them the hardest. But then look over at North America Pet, powered by Blue Buffalo. Sales are up 4% and profit is up 3%. And even better was North America Food Service. That's the part that sells to restaurants and schools. It saw profit jump by a healthy 13%. So the takeaway here is pretty clear. While the grocery aisle was a real battleground, the company's bets on pet food and food service were definite bright spots, providing some much-needed growth.
So with a mixed diagnosis like that, what's the treatment plan? Well, that brings us to the Accelerate Growth Plan. This is management's strategy for navigating this really tough environment.
The strategy is really built on four pillars: boldly building their brands, relentlessly innovating, using their huge scale for efficiency, and standing for good. This is pretty much their corporate playbook for trying to get back on track. Now, a key part of their strategy, even in a tough year, is to keep your investors happy. And one big way they do that is through dividends, paying out over $1.3 billion. That's a pretty significant commitment, and it's a signal to Wall Street that they're still confident in their long-term stability. And that wasn't all. They also spent another $1.2 billion just buying back their own stock. You add those two together, and that's over $2.5 billion returned directly to shareholders. For a company that's facing some headwinds, that's a powerful statement of financial discipline. Okay, so we've reviewed the past year, and we've looked at the strategy. Now for our final section. What's next for General Mills? Let's take a look at the company's own forecast for the year ahead. So their official outlook for next year shows a very, very cautious strategy. They expect sales to be basically flat. But here's the real headline. They're forecasting that profits and earnings per share are going to fall by 10 to 15%. This tells us they're planning to fight for every customer by investing in things like promotions, even if it hits their profit margins hard in the short term. So that leaves us with this final, forward-looking question. The company is bracing for another tough year. It's willing to sacrifice short-term profit to protect its long-term market share. But the real question is, can its biggest, most iconic brands convince price-conscious shoppers to stop hunting for deals and start paying for premium again? That right there is the multi-billion-dollar question hanging over General Mills right now.